Hi there, this is Steve Miley with another masterclass. I'm going to take a look in this masterclass at a brief introduction to technical analysis. And there's going to be lots in this series on thebull.com.au on technical analysis. We're going to do the brief introduction first of all, and then we'll go into some slightly more complex topics as we move forward. So introduction to technical analysis. What is technical analysis? We're going to be looking at that first of all in this video. We're going to take a look at different chart types, and then we're going to move on to look at time frames and how we kind of alter our time frames depending on our view and our outlook on the market. So what is technical analysis first of all? Well, really it comes down to the principles of technical analysis. What is behind the theory of technical analysis? Well, technical analysis at its root is very much the use of charts to make trading and investing decisions, whether it be the direction of the trade, i.e. are we going to buy the market or sell the market? Are we going to establish a long position or a short position? Or whether it's to establish potentially levels to enter the market and levels to exit the market. At which price levels are we happy to enter and exit trades or investments? So this is based all around the principles that we have, the underlying principles or tenets of technical analysis. And what are they? Well, the first principle we're going to look at is the price discounting everything. Everything we know about the market, the fundamentals, the macro, everything there is to know about any particular market, technical analysis assumes that that is then discounted and priced into the current price. And you have to buy into that to be a believer in technical analysis. The second basic principle is going to be the price. That price moves in trends. The market moves from an equilibrium point. The market is in equilibrium. Certain news affects the market, or certain ideas about the market affect the market. Buyers and sellers interact, and when the market goes from a phase of equilibrium, when the market is more in a range environment, and then trends to a new equilibrium. It goes through a disequilibrium as it trends into a new equilibrium level. So that's the second principle, that price moves in trends. And the third principle then is that history repeats itself. One of the primary factors that drive market are emotions, and those emotions stay constant because it's human interaction over time. So although the events influencing any particular market are the same or similar over time, the reactions to different individuals remains the same. And because of that, in history, these kind of different price patterns that we see in markets tend to, not exactly, but tend to repeat themselves. So we're going to look at now different chart types that we could potentially look at in technical analysis, different ways of analysing the market. So chart types first of all. The most basic chart is the line chart. The line chart simply connects the closes on any individual day, usually on a daily chart, and is connecting the closing prices on any amount of days. So it looks like this. So this is a weekly chart on ASX 200. This would actually be daily closes in here. So each point is a close on a weekly basis, and it's connecting those closes to form a line chart. So that's the most basic chart we can have. The second chart we're going to look at is the bar chart, also known as the open high low close, or the OHLC for open high low close, the bar chart. So the bar chart is a vertical line, represents the high and low, so for any period. So on a daily bar chart, the high and low of the day would be, so we have a vertical line, and the low of that line would be the low of the day, and the high of the line would be the high of the day. On a 1 hour bar chart, the low would be, the low of the vertical line would be the low of the day, and the high would be the high of the day. And then the close and the open are represented on by vertical lines on either side, by a horizontal vertical dash either side on the vertical line. So let's take a look at what that looks like. I'm going to just skip through in here. So on the bar chart or open high low close, we have the high here, the high of the day. So if this was a daily chart, would be the high of the day, the low of the day. Now the dash to the left is the open of the day, and the dash to the right is the close of the day. So here's an example of the daily Australian dollar chart in here. We have the market moving in a consolidation theme, but each one of these bars represents a day with the low, the high, the open, and the close. So that's a bar chart. The next chart we're going to look at is a candlestick chart. Now this is similar, as you can see, to a bar chart, but in this case what we have is the period in here between the open and the close is coloured in. Okay, so, and it's bullish. When it's bullish between the open and close, so the open is here and the close is here, it's bullish and it's coloured in, usually white, sometimes in today green, and when it's bearish it's black or sometimes red. So between the open is above the close in here. So this would be bearish, this would be a bullish candlestick. So the candlestick chart is similar to the bar chart, offers some more information. It's slightly different in its visual construction. The formation of a wide bar on the vertical line, which illustrates the difference between the open and the close, which we just looked at. That coloured in section is called the body, or the real body of the candlestick. If the close is lower than the open, as we looked at, the body is shaded in, often black, sometimes red. If the close is higher than the open, the body is usually clear. That will be the bullish candlestick. So then it will be white or sometimes green. The thin lines above and below the real body are called the shadows, also called the candlestick wicks. And the peak of the upper shadow is the higher the period, and the bottom of the lower shadow is the lower the period, as we already mentioned. So here's an example of a daily chart for a daily candlestick chart for ANZ Bank, and you can see in here the high and low. So this was a down day because it's in red. So the high and low are the extremes, as on the bar chart, and then the open will be higher and the close lower on this daily bar here, as the market has sold off during the day. There are some other chart types. We're not going to go into detail on those because they come a little bit more complex, but we'll take a quick look at those and just mention those chart types. So we have a point and figure chart, which looks like this. We have a market profile chart, looks like this with these series of letters. And we have a Heikin-Ashi chart, which looks like this, similar to the candlestick chart, but different in the way it's formulated. So there are other charts as well outside, but what you often see are line charts, bar charts, and candlestick charts. Final thing we're going to look at in here in our introduction to technical analysis are time frames. So time frames are appropriate really to which time frame chart you look at. So whether you're looking at a weekly chart, a daily chart, or maybe an hourly chart, or a 4-hour chart, or maybe even a sub 1 hour chart, maybe looking down at a 15-minute or 30-minute chart. The time frame of the chart you look at is going to be pertinent to the trading time horizon you have. And generally we say that the longer the chart time frame we'll be looking at, the longer time horizon for the trade, then probably the bigger time horizon you would look at the chart. So for example here, for a swing or position trader, someone who's maybe opening a trade and holding it for a number of days, certainly going into maybe a number of weeks, okay? So slightly longer term chart in here. We'd probably be looking at maybe daily charts for that kind of trade, okay? But however, on a shorter chart time horizon, we'd be looking at maybe shorter time frame of charts. So in here, maybe a day trader, if you were day trading, so you're opening positions in and out during the day, you would maybe zoom into a 1 hour chart. So just to recap in here, we've done a quick introduction to technical analysis. We've looked at the principles of technical analysis, what is technical analysis and the principles of technical analysis. We've looked at various different chart types, and we've looked at different time frames. This has been Steve Miley for The Bull, and please do join us again on thebull.com.au and thebull.asia. Stay bullish.